It means you will have to involve a lot of people, coordinate with the board, update all the prospectuses, you need to write all the policies, and then you need to test it with the fund administrator, so you can really like activate them quickly.
Today, I have the pleasure to welcome in the studio Marina Lukoyanova, who is risk manager at Mebs. Welcome.
Thank you. I'm pleased to be here.
I'm pleased that you are here because risk, of course, right now has a huge impact on everything related to finance, also industrial stuff. So I wanted to have your point of view on that. And first, could you share with us the trends that you see right now in the risk and valuation segment?
So we are at Mebs, we provide risk management and valuation services. Our specialization is governance, and the trends we are seeing right now in the market, like the first one is the enhanced liquidity management requirements. So this is coming from ESMA as well and from CSSF. So now FMD2 will come into force like next year on 16th of April. And it means that like the fund managers of UCITS and open-ended alternative funds, they need to pick two liquidity management instruments. So one of them ideally should be quantity-based, and the second one anti-dilution. Like
maybe just for readers and listeners to follow us, when we talk liquidity enhancement, it basically means if I want to do business, I need to demonstrate that I still have enough liquidity in case something wrong happens. Is that right?
Yes, that's right. And also for the funds, it's important that they have the option, let's say, to liquidate different tools if like the situation is like becoming bad. So for example, instead of suspending the NAV, they can just use instead swing pricing. So the outflows from the fund are not as severe as they could be.
So here again, maybe a little separation. We have UCITS on one hand,
yeah,
who are liquid funds. So theoretically, I should be able to sell my shares. We know that sometimes you don't find a buyer. So for this, you should be able to have solution to get liquid anyways.
Yes.
And then we have illiquid funds, like in the AFM spectrum.
So for illiquid funds, the one that like have like quarterly NAV or maybe monthly NAV, semi-liquid, if they're open-ended, they also need to implement this liquidity management tools. And I think as many as possible. I mean, that's the expectation of regulator. And as well, they need to document their policy, how they're activated, who is in charge, and like test them as well with the fund administrator. So if they can activate them quickly, same day, like how long will it take? Because in this case, if they don't have enough liquidity, usually with funds, they have some kind of liquidity buffer set up, but they cannot liquidate things quickly. So they need to be able to manage it also alternatively.
Yeah, that's why we talk about illiquid fund. Normally you're in for 5, 7, 10 years. So even the liquidity concept in this environment is almost abstract, no?
Yeah, indeed it's abstract, but if they're open-ended, then they have to be prepared for more scrutiny from the regulator.
Okay, so you could be forced to sell quickly some assets, and then of course it's as soon as possible. Sometimes it can last a few days, sometimes it can last a few months, but you need to demonstrate your plan in case something goes wrong.
Yeah, in case something goes wrong. And like the first phase, I think, when they looked closely at the liquidity was when they introduced the circulars 19733, for example, that like prescribes you like very detailed how your liquidity stress testing should be. Now, like there is more attention on liquidity management tools, but it's not gonna go anywhere. I think it will be even more complex in the next year and the year after, because like the market is not stable.
Okay.
Definitely.
So trend number one, liquidity enhancement. What is the second trend?
Second trend, we see that like sustainability is still part of the regulatory agenda. So the ESMA did this Common Supervisory Action 2024, and CSSF published the feedback in September 2025. And like when it comes to the risk management, they noted that actually the risk management policies and risk profiles, they lack clear indicators how the sustainability risks are managed and also limits. So this is something that like the management companies need to develop, how they're gonna be, how they're gonna measure like the sustainability risk, because it's not enough to say we integrated it when we did the investment, but also what happens after you did the investment, how like you, let's say, tracking this physical risk, let's say, for your investment. And this is a tricky part because if the listed companies, they have some information, they publish some information on ESG, and we're also providers for unlisted like private equity, debt funds. For them it's more difficult. But still they're obliged already to have some quantitative base for sustainability risks.
And we got a bad news from the Commission last week, because you know the Omnibus 1 was not voted, and it was supposed to relax a little bit all those obligations in the sustainability field. Well, now we need to wait until next month to see if anything progresses. So we seem to be in for further very strong regulation, even if it's hurting this segment of the investment spectrum.
Yeah, but when it comes to sustainability risk, there is expectation. It's not Article 8-9 funds need to measure them, but basically everyone. Article 6 as well, because these are like the risks that are there, and you need also like to have some, let's say, procedures in place. How you're gonna be monitoring them, how you're gonna be also escalating.
And which kind of risk do you see in the sustainable segment? What could go wrong?
What could go wrong?
Like a bad due diligence on the down the chain, so you might pretend it's all green but it's not, or how do you see things going potentially wrong?
Here, more like when it comes to the risk measurement, let's say if we take very simplistic example of the real estate, if you build it in a like area, for example, like Spain, according to many research and like different climate scenarios will be more, let's say, heat waves, the drought will be more severe. Also, if there is a waterfall, like rainfall, it will be also more severe. It will also mean that there, for example, this real estate will be exposed to these increased risks.
Yeah, that's a really good example, and it explains why you correlate risk and valuation. Basically, the main risk is the wrong valuation, so that when you need to liquidate, you suddenly realize what you thought was worth 10 billion might only be worth 2 billion. Shades of 2009 after the subprime crisis, if we follow the same example with Spain.
Yeah, indeed. I mean, there are like cities like Florida, which are the increasing area of like concern. And like some insurance providers, they even refuse to insure your building, you know?
Because it's built on a swamp?
Because it's built in an area where like the hurricane can destroy it, or like the tornado or whatever. So yeah, I mean, for them it's not worth it anymore even to insure your building. Okay,
so that's the second trend. It's all these enhancements of the regulation in the sustainable field. Do you see a third trend in the valuation and risk sector?
Yeah, so for valuation, I think there is still more scrutiny towards the illiquid assets and illiquid funds. And normally there is expectation that CSSF will revise the valuation guidelines for asset managers, for fund managers, and like they will most probably focus on stress scenarios. So how will you do your valuation in like market averse scenario? Like also the model like valuation framework. So how your models are validated, how often they're reviewed, like how well this whole process is documented. So this will be even more scrutinized, and there will be maybe more guidance on the separation between risk management and valuation. Because indeed many management companies, they have it together. So
there's a bias.
There is a bias. Yeah, there is a bias. So maybe there will be more clarity if they really should be like Chinese wall between them, or they still will allow like some proportionate, let's say.
Yeah, I do remember that the biggest scandal in the past 20 years were very often originating in the fact that the asset manager was doing his own valuation, and of course the bias was maximum. And at one stage, when the water comes down, we could see some bad things. So let's take it now from the other side. Let's take it from the investor's point of view. Which challenges are they facing, and also the fund managers?
So for the investors, it's harder for me to say. We are working mostly with the management companies to whom like we provide the consultancy services in terms of like risk management frameworks and evaluation frameworks. So there is obviously this challenge of regulatory burden And for last year, I think CSSF imposed 88 fines, more than 11 million euro. So this is real, but like regulatory pressure is
This was
on.
the fines, huh?
Yeah, fines, 11 million of fines.
But I think 5 million alone were for Spurkes.
Yeah.
So that takes it down to something
That
around like
takes it-
5.5.
yeah,
or-
that takes
but
it-
still, it's a significant amount.
Yeah. But what I can notice in my work when we interact with the management companies, that indeed regulation is very complex. So the complexity of it, and it takes a lot of coordination and resource inside to start implementing it. Because even if you say, like, let's say you're like open-ended fund that never had a swing pricing, and when one day you decided what you wanted because FMD 2 said so. So it means you will have to involve a lot of people, coordinate with the board, update all the prospectuses, you need to write all the policies, and then you need to test it with the fund administrator, so you can really like activate them quickly, and then you need to write all these contingency plans, and then you need to write all these contingency policies. So it means like just one line in the regulation, it means so many things.
It's a huge distraction from the core business.
Yeah, it's indeed a huge distraction from the core business, but given that liquidity will always be a concern, like also for ESMA, it's not gonna go anywhere. So you have to implement these projects, but again, I think if you do your day-to-day business, and when you look at it, you don't realize the amount of work that's like coming your way. If you decide to implement it, and the amount also of like project management you need to put into this.
So I see 3 scenarios here. The first is I manage, which means I hire people internally, and we deal with this new regulation. Of course, my costs are growing.
Yeah.
I'm trying to push a bit of this cost on my clients. It makes me less competitive. That's scenario 1. Scenario 2, I outsource to a specialized provider. That could seem logical, but still there's a cost, and I still need to maybe push it to my client, but I will become less competitive. And the third, of course, is I quit. Let's say I'm more than 50 years old. I don't want to go into this huge challenge, and I just try to sell myself. So we might see a wave of concentration. What do you see? Which one is the most likely scenario, or the one you see the most?
No, I think definitely scenario number 3 is right now on the market.
Okay, consolidation.
Yeah,
No need to do
yeah.
that. I'm selling myself to another provider, and we make economies of scales together.
Possible, but again, if you're investment manager and you manage your own funds, you kind of don't have a choice, you have to comply. So it's a lot of pressure on you also to explain to your group why you need to invest more resources and more money and hire more people to be compliant.
And it's fully in line with what CSSF announced recently, which is assets are picking up, and we see interest rate going down. And of course, as soon as interest rates go down, a lot of funds go up. But we also see less funds. So this goes exactly in the direction that you are describing. Maybe just to conclude, where do you see this going in terms of risk and opportunity for clients and for Luxembourg?
So as a risk management and valuation services provider, we notice that clients sometimes just want the technical solutions. So they want to design us a liquidity stress test, or like design us the metrics for sustainability that can be applicable to our alternative funds. But the second thing, they need maybe more strategic guidance because they want to understand where all this is going and like how they need to build their framework. But this has to be a tailored solution to them. So it's a lot like a dialogue between us and them, like how they can evolve and how they can build their own like robust risk management framework or valuation framework. So indeed for them it's important to understand where this is going, to see the big picture, and also to not just to do the day-to-day business, but somehow, like understand what's happening.
So if I wrap it up, I see a good news and a bad news. So the bad news is we are seeing a concentration with less funds and economies of scale. The good news is those who stay in the game are getting more and more sophisticated. They are getting more in the math, thanks to people like you. They are modelizing, they are getting more resilient, I guess, through all those modelization. So this is the pros and cons of the latest evolution of regulation. Is that right?
Yeah, but again, here it's all about strategy. You need to understand your strategy because you will be explaining to regulator why you work in the way you work and why you have certain processes. And if you don't have certain process, you also need to explain.
Yes,
But
yes,
again,
that's in the sophistication part. It's not just the math.
yeah,
It's about having a deeper, not only understanding, but deeper way to explain to the regulator, to the market, to your clients, where you go, how you go there. So more sophisticated font, I would say.
yeah, for sure, for sure.
Perfect. Well, let's hope also that at the same time the Commission will do what Draghi said in his report more than a year ago and repeal a few obligations that makes it so difficult right now to do business. And at the same time, I wish you a lot of success helping companies with their risk and valuation issue. Thank you
Yeah,
very much.
thank you, Jerome.